Hi you guys, welcome back to the channel. My name is Brad. This is the Firefighters Financial Toolbox. It's been a long time since I made a video on RMDs. For those of you who don't know the acronym RMD, it stands for Required Minimum Distributions. And basically what that means is for all your tax deferred accounts, whether they be traditional IRAs, 401ks, 403bs, TSP, whatever it is, if it's that money is tax deferred, the government eventually wants to get their money back. They want their taxes. So when you turn age 72, you have to start taking a little bit of money each year. And we're going to talk about how that works. First thing I want to talk about is the Secure Act. For years and years, in fact, since RMDs started, up until 2020 when the Secure Act changed it, RMDs were always taken at 70.5. So what do you need to know about RMDs? Let's talk about a couple of things real quick. First of all, age requirements. With traditional IRAs, you're required to take annual RMDs. If you were born on or before June 30th, 1949, you must begin at 70.5. If you were born after that date, your RMDs start at 72. While you must take your RMD by December 31st of every year, on the first one, you can delay taking that first RMD until April 1st of the year after you turn 72. But remember that means you would have to take 2 RMDs in the same year by the end of that year. So if you took one on April 1st because it was from the year before, you'd have to take a second one by December 31st. So think about that. So how are RMDs calculated? You guys, the IRS calculates this with a table called your life expectancy table. And it basically gives a divisor, a number that's divided into the balance. And that's the amount you have to take. And it does vary, and we're going to get into a calculator here in a minute and show you some different things. Okay, what if you have multiple IRAs? What if you have a traditional IRA or a rollover IRA from an old 401k, and you have a 401k? You guys, you have to calculate the RMD for each account separately. And the way you do that is by taking the balance of December 31st of last year. So let's say, for example, my balance of my 401k was $100,000 on December 31st of last year, but I've also got a traditional or a rollover IRA that has $250,000. Now, here's the thing that you can do. You can choose to distribute the funds from any or all of the accounts as you see fit. In other words, you can use one IRA account to satisfy all of the RMDs, but you do have to calculate them individually for each account. How many accounts you take it from is up to you. Once the RMD distributions. Once the RMD is taken from your account, you don't have to spend it. You have to take it out because the IRS wants you to pay the taxes on it, right? But you could take that money out and put it into a taxable account. You could take it out if you didn't need it to spend. You could reinvest that money. You would have to pay taxes on it, of course. So that's a good reason maybe to have a taxable account on the side. So if you don't need that money, reinvest it. Now let's talk about taxes and penalties. First of all, depending on where you live, and this varies by state, so make sure you know your state. Generally, your RMDs are taxed as regular income within the year they are taken, but RMDs can also be subject to state and local taxes. Again, that depends on your state. Some states don't tax it, some do. So make sure you check. If you fail to take the RMD, though, and this is the biggie, you guys, the IRS will impose an additional 50% penalty on your RMD amount. So for the example they use is your RMD was $5,000. You didn't take it. They can assess a penalty of up to half of that, you guys, a penalty of $2,500. You'd still have to take the $5,000, pay the penalty, and then you would still have to pay the taxes on top. So this is something that you don't want to forget to do. And ignorance is not an answer to the IRS. If you forget to take it or you didn't know the rule, they don't care. They will penalize you. All right, so let's go to Voya.com here, you guys. And this is there's a lot of RMD calculators out there. This is just the company that has my 457, so I'm on theirs. Now, this does have a few limitations, but let's take a look. So let's go ahead and hide the report. All right, so let's assume that I'm turning 72 this year. And I expect my rate of return on my investment to be 6%. Now you can adjust it with the slider and it will change the whole thing for you. But let's say I'm pretty aggressive and I think I'm going to get 6%. I have $500,000 in my account as of December 31st of 2020, which is what it's calculated on. And for this first example, we'll say that I have no beneficiary. All right, so here's a little graph chart that shows, but let's go ahead and view our report because this is kind of nice. It gives you the whole thing. So it says for my 2021 distribution is $19,531.25. And again, that's because I turned 72. And it breaks it down here. Shows my RMD. Now, if we go down here, first thing you notice is it starts going up and up and up and up and up as we get older, right? And then it starts cresting down. And we're going to talk about why that is. All right, so let's roll down to this. Now, this is the Uniform Life Expectancy table, you guys. You notice this number right here, 25.6. So if we take our calculator and we put in our balance, right, 500,000, and we divide it, 25.6, our amount comes out to 19,531.25, which is our RMD. Now, as you notice, these numbers get smaller. So as a 72-year-old, I'm taking about 19,500. Now let's jump up to 75. Let's go 3 more years. Now it's up to 23,134. Now let's jump up to 80. See what's going on? 30,165. Let's go up to 85. Now we're up to 38,354. So in 13 years, you guys, my RMD has increased. It's doubled. And so that can make a big difference, particularly if your balance keeps going up. Let's take a look. If we go to 90, now we're getting 156. And it looks like at 91 is when we actually start getting into our principal. At 6%, we've already been retired for 20 years before we actually start touching principal. And this is where eventually, at age 98, our RMDs actually start going down because our balance has decreased enough that it's a smaller amount. Now, this does change. If we had the report, let's go back. Now, let's say that my wife or my spouse is more than 10 years younger than me. Let me say it again, more than 10 years younger. There's a different table for that. Okay, and we're gonna leave everything the same, but I want to show you the difference here real fast. If we view the report, we notice that my first year is a little bit smaller, 19,011. So about $500 less, right? But we also see the table has changed. The joint life expectancy table is now being used, and you notice it's got my birthday, my age, and my wife's age. So instead of being 26.5, now we're at 26.3. It's a little bit smaller divisor. If we come up to 75, it goes up to 22,000. If we go to 80, it's only at 29,000. If we go to 85, again, we're a little bit less than double, but you can see that these amounts are smaller. And they've done that so that because your beneficiary, being my wife, is younger, they know that it's going to make that account balance last longer. It makes the amount you need to take out lower. So you guys, this is something that everybody will have to do if you have any kind of traditional assets saved in your retirement accounts, whether it be a traditional IRA, a rollover, a SEP IRA, if you've got a 401k, 403b. If those aren't in Roth money, then they will be subject to RMDs. In fact, even if you have a Roth 401k, if you leave that in the 401k, it also will have required minimum distributions. Of course, you won't be taxed on that money, but this is why most people, when they retire from their job, if they have Roth 401k, they roll it to a Roth IRA, so then it is not subject to RMD. All right, you guys, I hope you got something out of this. If you did, do me a favor. drop me that like. It really helps the algorithm, gets my videos out to more people. If you have questions about RMDs, you guys, put them in the comments. If there's something that I forgot to mention, and it's certainly possible, it is something that's important to my viewership, and I think it's something that we have to think about, because as you guys know, taxes probably aren't going down in the future. And so it can be a huge part of tax planning for you, and basically what we need to do to try to minimize those taxes when we are in retirement. All right, we'll see you. Thanks.